Now, let's do some business from the corporate side. And even though the markets are well closed at this time, we're seeing results. For instance, I think the most recent one is that of Wema Bank. We saw Wema Bank deliver a strong financial performance in at least 5 years, reporting a remarkable surge in both gross earnings and profitability. The audited financial statement for the year reveals that gross earnings jumped to 433.43 billion naira, driven, according to them, by robust income and strategic asset expansion. Profit before tax also went up by 141% to 102.5 billion naira. As part of the report, the Board of Directors proposed a 1 naira dividend per share for investors. Well, they say most of their money was made by giving out loans and investing in government securities. Other than this, over time, we've also told you about, for instance, we had Fidelity Bank yesterday. Also, we see that their profit before tax also up 210.0%, 385 to 385.2 billion naira. The gross earnings also went up 87.7%. Profit after tax was up 179.6%. And dividend was 2 naira 10 kobo per share. We've also had Zenith Bank. Zenith Bank, we did see that, of course, theirs was also positive. We saw audited finance for the year, a double-digit year-on-year growth of 86% in gross earnings from 2.13 trillion to 3.97 trillion. It was driven by 138% increase in interest income, supported by investment in high-yield government securities. Profit before tax went up 67% to 1.3 trillion naira from 796 billion in 2023. Net income went up by 135 from 736 billion in 2023 to 1.7 trillion in 2024. So it does seem like mostly the banks, you know, we had talked about, we didn't see the results from the banks, even though we had seen those from a lot of consumer goods and other corporates that are listed. But so now we see the banks are now sending it in. Let's find out what this result will tell us about the health of the financial sector in Nigeria. And we're doing this with the Chief Executive Officer of Star Advisory Limited, Mr. Kevin Ekulafo, joins us from our Abuja studio. Mr. Ekulafo, good afternoon and welcome to the program. Happy holidays to you.
Happy holidays, Ini. Thank you for having me.
Great. So when we see this, I mean, impressive numbers, most of the banks, we see their assets grow close to 100%, more than 100%. Gross earnings also up, a lot of them up to 100%. Are we in a safe place? And we know that the bank's recap is remaining just about 12 months. Would you say the banks are good? Business is going on as usual. We see Wema Bank is very emphatic with the fact that they have made their profits through loans that they give out. So would you say, looking at the workings and the numbers around the banks, we're in a very good place at this time?
Thank you for that question, Ini. I would say that about a year ago, I was here in your station, and I remember dissecting what the likely outlook for the recapitalization process would be. Now we're 1 year into that, and about a year more to go. I would say that looking at how it has shaped up, a few things have worked out for the big tier 1 banks. They have been able to invest in technology. As you well know, sometime in December last year, you know, a number of banks transitioned from one core technology to the other, and we had challenges with payments on some of their platforms. All this is possible because of the investment that is now made possible due to the initial capital that was raised by those banks. But I wouldn't say that it's uhuru yet. there is need for more capital for the banks. Also, the regulatory environment right now, where CRR is at 50% as a result of the MPC taking a decision to jack up the CRR to sort of cool down the inflation in the economy, is having an adverse impact on the banks and making it difficult for them to be able to meet the needs of their customers who require some credit facilities to grow their business. I'm aware of Access Bank has gone to the capital market to raise commercial paper, 193 billion. I'm aware there are 3 other banks also already either have sought the approvals of SEC or are in the process of doing that to also access the capital market. And this is at the very same time that you have so many other banks trying to raise, whether you call it private placements or having their existing shareholders invest in rights issues, or even going for IPOs, outright IPOs, you know, or looking for strategic investors. So the capital market is really, really crowded right now. There are so many deals, and it's good for the capital market, it's good for the economy, but I would say that the banks are definitely struggling. The treasuries of those banks are struggling to be able to meet up with the capital requirements of their customers right now.
So you mentioned the CRR at 50%. Explain to us how that is putting pressure on the banks.
Okay, so banks, basically their job is the intermediation. That is, you move money from the surplus side of the economy to the deficit side of the economy. So those who deposit money, who want to have that money sometime down the line to use for their personal needs, the bank takes that money and lends to those who want to do business. Now, by keeping CRR at 50% means half of all the deposits of all these commercial banks and merchant banks, I mean, for the commercial banks who are 50%, cannot be used for anything. It's kept with the central bank. It's basically sterilized. Now, that means the banks have only 50% of their deposits to do business with. Now, the pressure that causes is that cheap funds, which would have been used for lending, is taken out of their reach because the CBN is trying to cool the inflation. And now banks are now forced to say, okay, I have exhausted what I have. I am under pressure to meet my customers' needs. I don't want my customers to leave me and look for other banks to deal with. So I am now forced to go to the capital market to get expensive funds in the form of CPs, commercial papers, maybe 90-day, 180-day, or 270-day commercial papers for short-term working capital for me to on-lend to my customers. So that's exactly what's happening now. So it increases the cost of capital for banks.
Yeah, but doesn't the high interest rates give a buffer?
High interest rates, yes, you make more money in terms of high interest rates for the banks, but there's still a challenge. If you have high interest rates, you are declaring these beautiful results you see, but there's a challenge that you could lose your customers as well. And you don't want to do that as a business. You always want to increase your customer base, and for you to do that, you need the resources to be able to lend to them. Now, when you do not have that money because half of your deposit is sterilized because of inflation targeting, you are now forced to look for alternative sources of capital to lend to those customers. There's also a negative side to this. So if you raise a CP, for example, you are raising at maybe 24%, and the bank still needs to make money on top of that. So at the end of the day, the final lending that goes to the customer, the cost of lending to the customer, would shoot maybe 36, 37, 40%. Currently, that's what some of the banks are doing. And you know that is damaging to our economy. It's difficult for any SME I know, or even the big businesses, to cope with a range of 37, 40% interest rates right now.
So if, assuming we can create a scenario, we know that inflation is high in the country. which is why the CBN says it is determined to tame that inflation. Assuming that CRR is now reduced, could you create a scenario of how it will feed into the real sector or the real economy and the impact it might have, when you compare that, because there's a price for everything anyways in life. So when you compare that to the issue of inflation, what picture can we see?
So I think if you are reducing CRR, the CBN isn't unaware of the fact that a massive release of funds by these banks could also drive up inflation. But I'd also say that, if we do not do this, we also stand a chance where the cost of lending will balloon beyond the reach of customers. As I well know in my business, I know a number of clients that have shrunk away from going to banks for lending right now because the current range of 36, 37, 40% interest rate regime is difficult for businesses to be able to do what they do and make money and repay those loans. As it is, even the NPLs are gradually inching up. So we need to find a careful balance. And I know that in the last 2 months, from January and February, the inflation has been inching downwards slightly. It's somewhere around 23% right now. So I would expect that by the time the numbers for March comes out, you would find that it most likely has also inched slightly downwards. Now, at some point in Q2, we would be expecting that the MPC will start looking at how to reduce either the CRR or something to make sure that the rates start coming down, the lending rates start coming down. MPR needs to start, coming down. Even if it doesn't happen in April, we expect that sometime maybe in May or June we should, get the MPC decision, and we hope that it will start inching downwards because of the impact on businesses. And the president is looking for a $1 trillion economy. That's not going to happen if the cost of funds is quite high for businesses.
So now we see the results from full year 2024. Fast forward to the end of 2025. How do you see this result? What numbers do you think we'll be talking about by this time next year?
So I believe that for most of the banks, it's going to be a much better picture. They will mobilize more deposits. They are going to be more tech savvy because now they have a lot of funds to be able to invest in platforms, in software. They, in the last maybe 5 years, were pushed out of the fintech space by the big fintechs who were raising a lot of funding from VCs and all that. Now there's going to be a heavy pushback by these banks. So I expect the fintechs should brace up. They're going to have some of their market share eaten up by some of these banks who are going to be investing heavily on their tech platforms. So definitely, for those who have holding companies, some of those fintech platforms they own are going to be making a lot more money. So I expect these numbers to improve significantly in a year because even in that 1 year from now, some of them are still going to go to do further raising. Access Bank, First Bank. First Bank is trying to do private placements. I know many of them are still looking to come back to the market to raise additional capital, and that is going to make them much stronger, both in Nigeria and on the continent. I can see there are plans for a number of them to even spread wider, even beyond Africa. So that is going to make them more robust and make them stronger and make it unlikely for some of them to fail. For the tier 2 banks, maybe 1 or 2 of them might eventually enter into tier 1 status. The likes of Fidelity and FCMB are looking likely that anytime from now they would be joining the tier 1 banks and the tier 1 status. For the tier 2 or tier 3 banks, we hear there's a merger between Providus and Unity on the books. We expect that will be concluded by then, and that unified entity will be much stronger, knowing that Unity is a bank that is well represented in the northern part of Nigeria. So under a merged entity to be stronger, So you look at some of the other smaller banks, the banks that just came on board, even the merchant banks and all that, a lot of them are going to be stronger. And I expect the numbers that will be seen would be more. The only challenge I see, of course, with AI and some of the technology we are having on board is that there might be loss of jobs because banks would deploy a lot of technology now that they have the funds. And that might not go well for some people. So I would also put it out there that anybody out there who works in a bank should go and get more training and retraining to make sure that they can retain their jobs.
Yes, and you talked about the fintechs. I hear it's more of collaboration now between the traditional banks and the fintechs. It's not a lot of competition. So I guess we'll be seeing new trends by then. And also, by this time next year, we'll be talking about the recap coming to an end. So, so there are so many things that would define the banking sector by the end of the year and early next year, yes?
Yeah, I must put some context to that. Even though I said the banks are going to push back, it's a competition. Even though there's still some partnerships, they can't do without each other because the fintechs also keep their monies with the banks. So it's a partnership. But I would also say that there are a number of those fintechs that have become mature now, the likes of Flutterwave, the likes of Paystack, the likes of MoneyPoint and Kuda. I wouldn't be surprised if we hear tomorrow that MoneyPoint is acquiring one of the tier 3 or tier 2 banks, or there's a merger between Kuda and some other bank. As you can see, some of these nascent banks are already poaching some of the top eggheads you have in some of those big banks. Not too long ago, the CFO of Stanbic Bank joined one of them. So that tells you a lot, and that tells you the strength of some of these
those that you
fintechs.
thought were the small boys are taking over, but it's obviously going to be very interesting. Yeah, it's going to be very interesting.
Yes,
that space
it's going to be an interesting sector to watch post recapitalization.
Exactly. Thank you so much, Mr. Kevin Kalu, for Chief Executive Officer of Star Advisory Limited, for your time and your views this afternoon.
It's a pleasure being here.